I don't like theories that involve secret manipulations. I think that stupidly explains much more than malice, and even when there are manipulations, there is often a way to reason, all things being equal, in terms of dynamics or behavioral change. However, when it comes to gold, I don't understand. All tangible assets, be it real estate, stock, commodities, or energy, are in inflation. Even Bitcoin seems to be benefiting from this rise of everything. Yet, gold and silver remain unaffected. Since the March 2020 crisis surge, little or nothing has happened. For a whole year, gold has remained in a range between $1,700 and $1,900 per ounce. For silver, it's not much better. In the last few days, I came across an article by Laurent Morel, who is the CEO of Bay Research, a company specialized in the study of the gold mining market. So here it is. Today, I'm presenting you with a point of view on a very technical and muted field, the gold and silver market and their quotation. Come on, let's go. The observation is simple. As I said, everything is rising except for gold. The refrain is always the same. The inflationary crisis that we know is temporary because it is a counterblow to the crisis of the anti-COVID measures. Basically, the economic machine was hit hard and stopped overnight, so it is sputtering when it starts up again. However, from an investor's point of view, there are signs in the US that this inflation does not seem to be as temporary as all that, as real estate prices are skyrocketing. But real estate is a long-term purchase. Moreover, we observe that real estate is once again an object of speculation, since investment banks are returning to the real estate business as well as the richest Americans. In short, something is happening and it does not seem to be a matter of a few weeks readjustment. I share this opinion because our indicators in Naystor, our online free management assistant platform, indicate rather the setting up of a trend than a little jump. As a reminder, in Naystor, we observe these changes in inflationary dynamics by calculating short-term and long-term inflationary paths. And honestly, on this side, inflation seems to be settling down well all over the world, with the exception of a few countries. So, why are the silver and gold markets generally unmoved? In Laurent Morel's article, he talks about a manipulation of silver prices, in this case, linked with the derivative market of future contracts. The principle is quite simple. A future allows you to buy or sell a given asset at a future date. For example, at the time of writing for oil, if you want to buy a future for delivery in September 2021, it'll cost you about $66. What is the benefit of these future markets? For example, let's say I'm a jeweler and I schedule my jewelry production for next month. I know I will need to buy X kilos of silver by September, but I want to insure myself against the price variation. So I buy the equivalent of what I need in future contracts, and in September, I am sure I will have the cash flow to buy the silver I need. Whether silver is $30 or $15 in September, with a future bought today, you will be sure to have $23. Futures are found in all commodity markets because they are originally an insurance mechanism. It works the same way for a farmer who wants to fix the price today of his future crop next year. In terms of the financial market, observing the value of these future contracts allows one to form an opinion on the market's expectations of commodity prices. So, if you are a criminal and you want to manipulate the price of a market, looking at future prices is a good option. So, Laurent Morel explains to us that silver prices are manipulated at this level, on the futures market, because they also have the good fortune to be less monitored than the instantaneous market that we call spot. And this resonates with me, because in April 2021, I made a video on this subject as I found it very strange that the premiums on silver coins were equivalent to a period of financial crisis when there was no financial crisis. Basically, in this video, I explain that silver coins are in high demand on the field, but that doesn't translate to the courts. Strange. Occasionally, I told you about a Wall Street bet thread, which addressed this topic and proposed to be a short squeeze on silver to pay off the Wall Street bankers just like they had paid off the Citron Research Investment Fund with the GameStop story. So the plan is simple. The participants in this Wall Street silver thread have taken it upon themselves to accumulate as much physical silver as possible so that short sellers will eventually be unable to buy back into the markets when their short positions end. Put another way, when you are a silver speculator selling short, you are carrying a debt in pounds of silver that you must repay by buying back silver in the market. If there are too many short sellers, it is possible that there is more metal to be bought back by short sellers than is available on the market. If you are unlucky enough to be a short seller and you are unable to buy back and prices are rising, then your losses are virtually unlimited. In the case of a short squeeze on a stock like GameStop, one way to find shares to buy back, even if they are expensive, is to go to shareholders who have shares in the company but are not listed on the stock exchange. Basically, if there are no more McDonald's shares on the market in New York, you go to Mr. McDonald and beg him to sell some of his shares. In the worst case, if Mr. McDonald doesn't have any shares, he might do a capital increase to create some for you at a price that is expensive but that allows you to get out. This is what AMC did when Wall Street Bet members made AMC's stock prices explode in the same way that GameStop's prices did. On the other hand, in the silver market, if physical silver runs out, it could be more difficult for short sellers to negotiate, since silver cannot be printed. Depending on the magnitude of the fraud, it could even be seen if investment banks and other hedge funds started to go around looking for institutions with strategic silver stocks that they would be willing to sell to get them out of trouble. In any case, the Wall Street Silver Forum, dedicated to silver short squeezes, already has 126,000 members. On this Reddit thread, we see individuals showing off their stock of physical silver spread out at home in the hope of causing a masterful short squeeze. But are these manipulations real? Do we have any proof? Any clues? Well, yes. No less than 2 major trials have resulted in a conviction or a settlement to close this trial involving JP Morgan, the largest American bank and former traders of Deutsche Bank, which is also a heavyweight in the global banking industry. Can we assess the extent of this manipulation? All we know is that the quantities of physical silver metal are falling on the exchanges because it seems that long-term investors want to get out of a paper holding that may never be honored. Moreover, this is one of the issues of the Basel III reform, to limit the expansion of paper metals in relation to the real quantity of physical metals on the market. On the one hand, the objective is to reduce the risks to which the banks are exposed. On the other hand, it will allow them to fight against the manipulation of these markets by depriving ammunition from those who would be tempted to do it. Concretely, Basel III, which came into force in June 2021, now imposes a long-term structural liquidity ratio, NSFR, net stable funding ratio, of 85%. The objective is to limit the leverage between a physical asset and its derivatives. So, has the world changed since this new regulation came into effect? Well, no. At the very least, we can say not yet, and at worst, we can already see the counterfires being lit by the giants of the precious metal markets. The London Precious Metals Market, the LBMA, has clearly stated its disagreement with the NSFR, and the British regulator announced on July 10, 2021 that the LBMA could opt out of these rules in favor of simplified rules that do not jeopardize the London's precious metals market in its current form. Thank you. Subject closed. With one of the world's largest markets on their side, are the manipulators of precious metals prices definitely safe? History has shown us that long-term market manipulations always collapse under the weight of their contradiction. That's why it makes sense to have physical gold or silver, but keep in mind that it's potentially a very long-term view. If you want monetary assets that move, there is Bitcoin for that. With 100% volatility per year, you won't be lacking in thrills. On the other hand, in terms of diversification and very long-term savings, I also have gold in my safe deposit box because right now, having anti-fragile assets positioned against the money markets is not a luxury. On that note, see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.